Welcome to Module 9, where we'll be looking at absorption order flow events. Okay, now let's look at the content structure of this module. Firstly, on slide 3, we look again, so we consolidate this learning, the knowledge matrix and what part of that knowledge matrix the absorption section sits. In slide 4, we look at just the overall module structure, what we'll be looking at throughout the whole module. Slide 5 and 6, we start defining what is absorption. Slide 7, we look at key considerations in identifying absorption zones. And then from slide 8 to 10, we look at trading strategies around order book absorption events, which always makes it exciting when we start having to deploy the right trading strategies when we observe absorption patterns. And then slide 11, we have the live drill practice to consolidate your learning at the end of this module. We now find ourselves in the absorption part of the section of identifying all the various different order flow strategies, the execution strategies, and in the absorption area we'll be looking at specifically 4 types of strategies, and we're in this green zone now. So we looked at large orders in the previous module. Now we're looking at the absorption section and really focusing on the trading strategies around absorption and what type of market environment we want to see in order to deploy the right strategy. Let's look at the module structure for the absorption part of this course. So there are going to be 3 main learning videos. We'll be looking at 5 replay drills. Then we'll have a Q&A session. We'll be looking at 5 main strategies and 1 exercise at the end. And remember, we'll be also focusing on the optimum market environment. Now, before we look at the various trading strategies around absorption observations on the price ladder, let's start defining it. So what is absorption? It's the passive or active buy or sell orders that take the form of the following order book strategies: iceberging, which we'll be going into a little bit more detail; time slice orders. Please click on that link so you can see the definition of a time slice order and also how to execute it on your trading technology platform. Then you also get volume slice orders. Again, click on that link to understand what a volume slice order is. And remember, the most recognized order book strategy for absorption order book events is iceberging. And again, this is when someone is trying to hide their orders away by not displaying their entire order. And then as the market trades into it, the price effectively starts reloading in a classical, simple vanilla iceberg. The following is the definition of iceberging via Investopedia. An iceberg order is a large single order that has been divided into smaller lots, usually through the use of an automated program for the purpose of hiding an actual order quantity. And let's continue to define what is absorption. So when large participants, such as institutional investors, need to buy and sell large amounts of securities for their portfolio, they can divide their large orders into smaller parts so that the public sees only a small portion of the order at a time. Just as the tip of the iceberg, it's only visible portion of a huge mass of ice. By hiding its large size, the iceberg order reduces the price movements caused by substantial changes in stock supply and demand. So when we look at the large order book strategies, we notice that if we observe as locals a large order, and it's a genuine large order, once we've defined that it's identified that there's a high probability of being a large order, you can effectively move the market away from that large order, and therefore that large order is having to execute at worse prices. So this is really the rise of the iceberg. The iceberg order is that if you don't display a order that sticks out like a sore thumb or like an iceberg on the price ladder, you can effectively get away more advantageous prices as you don't get the market to chase. But when locals and intraday traders observe the reloading of a price and an absorption, we can actually start trading within that iceberg, and therefore it's the ability of the trader to observe that iceberg before that iceberg disappears, and you can actually start scalping, extrapolating profits from the iceberg order. So remember, iceberg orders are used to avoid locals and other market participants front running at the order, as we've just discussed. You get manual versus automatic iceberging. The most predominant one are your automatic icebergs. So you put in an order. If you go look on the Trane Technologies order types, you go look at iceberg, how to actually construct your iceberg pattern. We'll be looking at in the videos, and really making you understand what an iceberg order looks like when we go through our price ladder order plays and strategies that we do deploy. Other trader lingo for iceberging is reloading. So you'll hear a lot of traders, they don't really call it iceberging. They say, oh, someone's reloading the bid or someone's reloading the offer. So that's when a trader is making observation of a buyer or seller at a price or a price zone. You can have an iceberg that's distributed within 5 or 10 ticks. And so this is important. These are other important considerations. The time frame and purpose of the iceberging. It really ensures that it gets the best price fills without being front run if the entire order is disclosed. So effectively, why do institution traders use absorption order book events? It's the best method to observe a key absorption event. So really critical to understanding what is an iceberg, what is an absorption, what does reloading look like, and what environmental conditions you really want to observe these patterns. And when you're seeing a rapid reloading of a price, which we shall illustrate in a video in the next couple of slides. Let's look at key considerations in identifying absorption zones. Firstly, it's understanding the relative speed of your market. Now, when a market is oscillating in a certain range and then it meets a certain price point or a price zone, and all of a sudden the orders start accelerating, but the actual price is not budging and the market's not advancing on the upside or declining on the downside, and the speed of orders that are going through would generally mean that the market would advance or decline, but it's not. Well, those are one of your first key considerations in understanding the relative speed of the market is so important in determining whether there's an iceberg order or not. And also understanding the auctioning rate versus time spent. So, the greater the velocity of the auction, the orders that are being traded through versus the time spent. If it's trading 1,000 lots per minute, and the market isn't advancing, usually 1,000 lots per minute would normally result in the market moving 3 to 4 to 5 ticks as it takes out the relative average order size on the order book. But now it's not even moving more than 1 tick. Well, therefore already you're observing a potential iceberg in play, and now it's determining how big is that iceberg below the surface. And then also knowing when the counter side has exhausted its ammunition once the speed subsides. So if there is an iceberg order and you trading within it, but also understanding once the iceberg starts, once it really starts exhausting the other side of the market. So if you have an iceberg on the sell side sitting on the offer at 50, and all of a sudden all the buyers are effectively trying to lift the offer, and the iceberg keeps on reloading, then the buyers just start becoming lethargic and they're not being able to buy as aggressively as they did, and then it's now moved from 1,000 lots per minute to 400 lots per minute to 100 lots per minute. Then all of a sudden, once the prices start declining, there'll be that pain threshold point for those people who've lost the battle against the iceberg, when all the orders have to start unraveling. And you'll see that in the videos that we look at. And this is really important, is knowing when the iceberg has effectively won its battle in that specific time frame. Also understanding the seasonal times of days and months. A lot of times you'll get iceberg patterns when the market's highly active and incredibly aggressive, and then it's easy to observe the patterns. And when do those occur? Do they occur, the beginning part of the month when risk is being put on the table, when there's a technical order flow such as month-end trades? Regardless of what time, it's just really important to understand the seasonal trends of the various markets, of when certain types of iceberg absorption patterns can occur. Now we're going to go look at the first order book absorption event strategy. So it's called the iceberging partner. Now what effectively you're doing is you're scalping inside the iceberg that you've located. And once you identify the iceberg, you really start maneuvering around it. So you observe the iceberg, then you start working yourself with the iceberg, and you start scalping around that iceberg. We'll be looking at these plays in a couple of video tutorials and a couple of strategies that will really be showing you how to effectively trade this. Now, the holding period of the trade is determinant on the auctioning velocity in the context of the market positioning. So if the market is moving very quickly in a in a short period of time, and then all of a sudden just hits an iceberg, and you observe that iceberg in a very intraday time frame perspective, you might just scalp for a couple of ticks in a couple of seconds. Whereas if the market is moving near a critical level that you've observed and it's iceberging it over a period of over a period of hours, well then you may be scalping in and around that iceberg, but also building a key core position that you might hold for the next couple of hours, because your level that you observe on the chart is being confirmed by price action. Now remember, it's one of the things I always say to the younger traders on our training floor. It's always easy to spot a level, but the difficult part on the skill is how you trade the level. So how you trade the level by observing the types of price action events that you're observing. So really important, it's the context of the market positioning, where it's located will determine how you maneuver around the iceberg. And we look at that in a couple of videos. Anything that's beyond the average activity, what we call anomaly auctioning events. What I mean by that is, the market is moving at one type of speed and momentum until it hits a price area that changes the way the orders are going through the order book, and the market's not advancing or declining in such a way. Well, then that starts becoming an anomaly from the recent activity or the time frame that you're observing. So it's an anomaly auction event, and that's what you're trying to observe when we look at our videos. When we look at all the videos and different trading strategies and the tutorials on how to observe this. The faster the pace of the market. So remember this is why great volume and great activity, and we look at this in our video tutorials. The faster the pace of the market relative to its average pace and intensity of the exchange, so intensity of the exchange between the orders and the orders sitting on the bid of the offer, the easier it is to see absorption patterns such as icebergs. It's really difficult to see when there's nothing going through the market to see, well, is there an iceberg or not? It's a lot easier to see if the market is moving aggressively and a price gets reloaded or price zone gets reloaded. So really critically and really important. Conviction levels will rise if it meets your critical charting reference point. So as I said, if you have a confluence of levels, you have a VPOC by a trend line and exiting a weekly value, so you have a whole confluence of levels, and then you see an iceberg and you see the market unable to penetrate lower, well then you can start scalping really aggressively, because it's almost a triple confirmation of a play, and you get in that confirmation from the particular type of price action that you are observing. And remember, it's the relative counter aggression of the market will determine the degree of the success of the iceberg strategy. So what happens is, we mentioned this before, so say the market is coming down. So the market is coming down towards this level, and all of a sudden over here is sitting an iceberg. Now you can't see that iceberg, but it comes at a certain trajectory and a certain speed. And once it hits that iceberg, then all of a sudden the orders are going at the same pace, but the market isn't able to budge even lower. So it's just sticking there. It's really holding there until the orders slow down, and then all of a sudden the iceberg just firms up, and then the market starts retreating. And the moment the market starts retreating, well then there could be a counter aggression, as all those positions who were shorting into that iceberg have to unravel themselves and cover, and you get this flurry of a move, and it's your ability to put yourself on that trade. And we look at that in the videos and in the tutorials. So remember, an accelerated iceberg auctioning event that then subdues the market has a greater propensity of protecting the price zone than an iceberg that exhausts its orders before the auctioning velocity dies out. So you can have an iceberg or reloading, but if the velocity is always constant, and all of a sudden the iceberg says, well, I filled my orders, well then the market can continue in its trajectory. But if you see an iceberg reloading and then the order velocity, we've just mentioned in the previous bullet point, the orders start slowing down and the iceberg is still standing firm, well then it's the counter trade that can prove rather market profitable in the direction of the iceberg. So just understanding of velocity in reference to the iceberg, that's really, really important. And that's really is the iceberging partner is trading with the iceberg. Really critically important on how you effectively trade that. We'll now look at a second strategy, order book absorption event 2, which is backfire machine guns, or the malfunctioning algorithm. And these occur occasionally in the market. When they do occur, you can really hop on it and profit very effectively, very quickly if you really leverage up. Now, you can click on that link and look at what a machine gun order is, but effectively they're usually employed just prior to the opens for optimal fills and optimal entries. But sometimes these occur during the trading session, which for me is actually a malfunctioning algo that wasn't supposed to happen. But these events happen where all of a sudden an algorithm goes into starts malfunctioning or goes into overdrive and starts executing a whole bunch of orders, either on the buy side or the sell side, or on both sides, on the bid and the sell, and it's just working one price, and you get a rapid firing of orders. And sometimes they're just at one lot at a time, but they're executing 1,001 lots in a second. So you just see it hitting the order book, and if that occurs in a low volatility environment at one price, effectively what you can do, you can put your orders on the buy side and the sell side, and you just get filled on both, and you can nick ticks at a time, and you can sometimes nick. I've seen algos where effectively you observe one and you're getting away. You're getting away 10 lots at a time, and you're trading it about up to 20 times, where you put a bid, get filled on the offer, put a bid, get filled on the offer, and you're doing that about 20 times, and then all of a sudden the malfunctioning algo finishes its business, and then it disappears. Now, we don't actually have an example here, but the moment we see one again in the marketplace, I'll load it up into this section, the absorption section, so you can observe it. So it's just something to bring to your attention. If you do observe one, don't be scared by it. Effectively go trade around it, especially usually they occur within the buy and the sell side, and they get in and out, and then you can join the bid, get out the offer, or join the offer and get out the bid, and you can really trade that very effectively with quite a bit of you can really expose yourself on the trade until the algorithm has exhausted itself and has finished. So really, the machine gun orders are usually used before market opens to get preferential order queuing. However, sometimes, as I've just mentioned, these machine gun orders are executed through a fat finger during the market session. What do I mean by fat finger? An accidental execution of the trade. It's a trade that had no intention behind it or never wanted, but unfortunately the trade was put on accidentally. So then our strategy as local traders is to spot the machine gun order and then scalp around it aggressively until the order finishes. Okay, so order book absorption event 3, and it's observing time and volume slice order distribution information gathering patterns. So effectively what we're doing is sometimes these are a little bit more sophisticated than the simple vanilla iceberg. As we've mentioned earlier on, and I wanted you to look into defining what a time and volume slice order on those links that I gave earlier in the slides. And really important to understand that the volume slice order can occur over potentially 100,000 contracts. And only gets executed every time 1,000 contracts go into the market. So it's your ability to now start looking at a more macro time frame or macro volume range. And sometimes when you observe an absorption pattern, it can occur over multiple hours, whether it's time or volume slice order. And it's your ability to see that over the bigger swing time frame that the market is really failing to advance towards the downside if there's a buy side time slice or volume slice order. And sometimes you can actually use on the various different platforms, or what they call aggressive buyers or versus sellers, or aggressive sellers versus buyers. Some they call it the delta of the market. And really important that this is more information gathering into the next day's trading opportunity, where a market is fixed in a zone for a long period of time, and then the next day when the market escapes that zone, you get a momentum move as the congestion disappears. So time and volume slice orders are more a contextual understanding, and And they can operate. You can get a volume slice order of say 50,000 contracts, and that can occur over a 20-minute period, and therefore that's a lot easier to see. But it's a little bit more difficult to see if it's over a larger time frame, and that's where your larger time frame contextual understanding is important, and that really develops as you gain more experience in this game. So as I've mentioned, these patterns can occur throughout a trading session and are harder to decipher from a micro time frame perspective, as the order book events are spread over an entire price or time range. The time slice order can say, buy me 100,000 contracts every 2 hours, and they use an iceberg to buy those. So it starts becoming more of a sophisticated type of algorithm when it's executing those types of orders. These execution strategies behind these patterns usually occur over a couple of hours, and therefore using the delta of the market as the main signal. So, for example, if the market has sold off passively all day, and it's sold off, but the delta of the market is meaning that is negative 120,000 contracts. So effectively, there's been people actively hitting the bid then of 120,000 contracts, but the market hasn't really moved towards the downside effectively. Well, therefore, you do know that there's been a passive buyer sitting there all day. And if the market, the next session, starts reversing that sell-side activity, you'll know that there's 120,000 contracts that will need to unravel. So that's using a larger time frame contextual framework. So it's important to show the structure and fast, and this is a more a technique of learning, is show the structure and fast rewind video of an increasing delta but market not advancing. So go look at your recording. Look at how the market's declining, but it's not declining effectively, fast enough. And therefore, if there's lots of sell side activity, but it's not going down, and you watch it on your video, you can actually see in a fast time frame of actually a buyer sitting there all day whilst you watch the sell orders going through. And then this really results in a potential next trading session, trading opportunity. Now let's consolidate all the learning from this section with live drill practice. And what I want you to do, this is a 1-week exclusive practice focusing exclusively on this module and this drill, and trying to develop your absorption recognition skills. I want you to find 20 absorption patterns in the following markets per day: in the Bund, the Euro stocks, the Euro USD, the gold market, WTI, and E-mini S&P. I want you to record your observations and learning using the following worksheet journal. So I want you to click on this link, download, print it, put it on your desk during your trading session. I want you to really effectively start looking at what market is. So you plot down the market, you plot down the time, the price or the price zone that you're looking at, what trade you executed, when you got in, when you got out, what was, and you got to mention what the absorption pattern was. Was it a machine gun order, an iceberging partner, or did you observe a potential volume slice zone? So the market was effectively iceberging within a certain range, or a time slice zone. And then what was the market environment? What was the velocity? What was the price auctioning speed? What type of liquidity was in the book? Was the volume low or high? And then what was your learning outcome? So you make these conscious recording, you record these effectively on your worksheet, and then you start developing your absorption recall skills and patterns in your mind a lot more effective in the future. So I want you to do this and locate 20 patterns a day. So that's really critically important, and you start building, and when you start recording in your learning outcome session, you start building your contextual understanding of when patterns work best, and as I mentioned, you record that in your learning outcome section, and therefore also you might develop your own pattern names and belief in your interpretation of the market. So there'll be a whole bunch of different patterns that might rise up from here. The more you start recording, the more you start observing your own subtle subtle patterns, and that is when it really starts becoming exciting and great, because you start developing your own patterns. Effectively, you could write your own absorption book, and that's what we want. We want you to have the ability to develop your own patterns from the foundational ones that we supply you. And then I want you to upload your top absorption pattern of the day in the community absorption room. So out of all the ones that you saw, load it up, put a voice to that video so other members can share in what they're observing, and make sure it's no longer than 2 minutes of the video. And I want you to upload 5 videos by the end of the week in the absorption module section. So all the best of luck. Learn a lot, record a lot, and make some really key observations this week with this, an exclusive focusing on the absorption module. All the best. Okay, welcome to an absorption play where we'll be looking at the bond market, and we're looking at this ladder on the right hand side. And so as we've gone through all the practical or the more theoretical elements of this module in the absorption, we will now look at it from a very practical point of view and look at where we can see potential icebergs, volume slice orders, time slice orders, and really seeing, as a lot of traders on trading floor in the future space call it, reloading. So we're going to be watching the bund here, and let me just draw for you in this instance, and let me get a nice pretty color for you. Well, it's not very pretty, it's just plain black, and we're going to be looking at this little zone over here. So now let's watch this market and look for potential absorption play, and we're going to be looking at something called, so if you did the market profile course, we're going to be looking at a VPOC shift, and so it's the most traded volume at a particular price. So it's the volume point of control, and there's a little play around that. It's almost a combination of a volume profile play in line with using the price ladder, and it's understanding how to use both of them together. So now let's have a look at this market. So the market has now traded towards the 14s, which is the high. Now as you can see, if you look and this is the current range of the market, and this is on a pre-futures, pre-cash session, so before 8 AM UK time. And once you start getting to know your market intimately, you start understanding what is high volume and what is low volume for your market, and what is high velocity exchange and what is low velocity exchange for a particular session. And because when you start understanding the personality and the nature of your market and how much it trades at certain periods of the day, you're absolutely able to understand when there's a potential reload, or when you see an anomaly amount of volume going through on a price. So what's actually happened over here is that the market had a VPOC over here. So you had about 2,600 lots at 167.02. You had over here, so you had over here 1,800 lots and 1,003, and then what happened? The market traded up, and then it shifted the most amount of volume up towards the 11s. So as you can see over here, we've got a volume point of control shift. This is the most volume traded at a price at 3,200. Now what's happened is that the market has flipped as we increased volume activity towards the high. The market flipped above the VPOC area. Now what's really important, is this going to continue? And this is what we're going to watch at the moment. So let's have a look how this trades out. So at the moment there's actually a little order, the trader's putting a little order here at 6709, this low volume node. But what we've noticed is that after it flipped towards the 15s, it's starting to shift back towards the 12s and 11s. So there hasn't really been a momentum shift towards the upside. So the market has just flipped up a few ticks, didn't trade much. And what you start happening over here, there's a seller reloading of the 13s. So if you look at this video again and you replay just before you see this little bubble pop up, you see that someone is reloading, not with much size yet, but with about a couple of 50 lots, and as the offer disappears, it gets reloaded again. So really important, just observing this pattern at the moment. So let's see how this plays out. So we can see now it's come back to the volume point of control at the 11s, and we're really watching this rather closely now. So as this market really starts trading, we want to start looking at a particular type of pattern, and the execution order flow type is absorption reloader, and this is how we create our methodology to analyzing all of our price ladder plays. So you have this matrix in your head on how to really develop your ability to read the price ladder. So then the pattern type is iceberg and volume slice zone. So what we're trying to see is, in this area, is there a seller that keeps on reloading the offer? And when we observe that potential seller that's reloading the offer, what type of trading strategy do we want to deploy? And the trading strategy that we want to deploy is we want to distribute amongst the iceberg and rapid scalp. So essentially, what I'm talking about over here is that, as you notice the iceberg, you want to maybe distribute some clips, in this area as you look towards maybe potentially back towards the low volume node, and you're scalping. So you get filled for one tick, you get out for one tick. You get filled, near the highs, you maybe take it for 2 ticks, and you keep on it so long as the iceberg is there, and as long as the iceberg is absorbing any buy type orders. You want to be working yourself and partnering yourself with the iceberg. So you want to be trading the direction of the seller that you are observing on the ladder, and this is where we're observing it at the moment, and you're distributing your clips. So that's the trading strategy. And then the ladder market environment, preferably high volatility and volume exchange. The higher the volatility and the higher the volume exchange, the easier it is to see a seller. When the volatility environment is low and the liquidity is low and the volume is low, it's very hard to see in a lethargic market if there's a strong iceberg, strong volume slice order, because there's not much flow going through. You can't see what's below the pond. There's no ripples. You can't see the fish. If it's very stagnant, there's not much activity, you can't really see what's happening below the surface of the water. And the same is true when you're watching the market. You're watching the market from the perspective of the price ladder. So let's now start watching this a little bit further. So we've just described what we want to do. And remember, the risk management, we're only taking 1 to 3 ticks because it's a rapid scalping strategy, and your reward management is 1 to 4 ticks. So depending, if you get filled on the 14s or the 13s, you could potentially look to get out of the 10s. So it's about 4 to 3 ticks. But if you're getting filled on the 12s, you want to get out of the 11s, and you're just scalping that area over here. So let's see what goes on here now in the next few minutes. So we're watching. So we've been filled at 12s. Okay, so we've been filled at 12s with 4 lot, and looking to get out at 10s. So the market, so there's a bit of a buy here at 11s, and what you'll notice here, all of a sudden the market does get flipped with not much size, gets flipped to 13. So what I mean by flipped is that not much size. So there, 13. Did you see that? The 13 reloaded, everything got taken, and then it got reloaded again. So looking to potentially join this the seller. So just been filled over here. The offer has just been pulled, but now this is quite important over here. You'll probably be exiting your position if it trades out towards 16, but just went short again at 15s, looking to scalp that out at 14. So we just got that out at 14s. We've come back to 13s. The market has really taken out all those bids again, and the seller at 13 has come straight back in again. So we'll watch over here, just sold 14s now. So really joining and actively scalping within this 15s, 14s, always joining the offer and looking to scalp, 1 or 2 ticks, but have a core position to get out at 10s. So again, what we're observing here is an absorption and a flip. So a flip, we look at that a little bit later on in the module. And what essentially the flip means is that a price is not fully representative of what trades through it. So you might have 114 lots here, but only 5 lots hits the offer or lifts the offer, and the rest of the offer disappears. So that's what you call a classic flip, but we look at that later on in the module. And as the VPOC shift has failed through, so we had the VPOC shift, moved up, and now it's come straight back in again. So it's kind of just a little pattern called the VPOC shift fail follow through, and then again we rapidly scalping the order book and really working this range. So, scalping multiple times, but your risk now is really above the 16s. It should not be trading above the 15s. So you can be holding a core position with a small clip with a 5 tick risk, then distribute your range clip 0 to 1 ticks, 0 to 1 tick. So effectively what you're doing is you can hold a core position over here, and as you've noticed, the seller, so you can take
you know, your reward 1, 2, 3 ticks, and then you're distributing your clips. So you keep on feeding the offer. So long as the iceberg is there, you keep on feeding the offer and you join the iceberg. So let's look how this plays out. So we already went short 14, got out some at 13. We're looking to get it some out at 12s. The 13 keeps on re-offering. You can see 100 lots went up, 400 lots went down, 11 just pulled most of its buy side order, and we're looking, we've just been filled another 2 lots at 11, so we've got 2 lots left now, and we're looking to get out the final position at 10. So we've just there worked this area, noticed the seller, and we're rapidly scalping. And this is, the best traders are not traders who can spot levels or tell you which way the market can go. The best traders are the ones who know how to manage their size in the right moment at the right time of day. You know, that is so key and core. And over here you've managed multiple positions in a small range because you've observed an iceberg. So that's an absorption trading strategy which you're joining the iceberg, and you're rapidly scalping at an extreme of day with pre-cash session. That's before the 8 a.m. UK time, before the European German bond cash session opens, and noticing an abnormally large amount of sell side orders going through the market when you see the reloading of the offer whilst the buyers start fatiguing on the buy side, and then you join the sell side activity. So hope you've learned a lot from that video. We will be asking further questions on absorption play, so really to increase your skill set. Welcome to the absorption module price ladder analysis, where we'll be looking at the Eurobond first, then looking at the Euro stocks, and we'll be looking at 2 plays on the bond and 2 absorption plays, where we really look at a very key region being the 45s, 46s and 47s, and we'll be looking at that in context with the volume and volatility that will be going through on the ladder, and how to observe various types of pattern. So what I'm going to be doing is I'm going to be playing this at 4 times the speed initially, just so we can get to the critical region that we want to analyze, and then we'll be looking as how we approach all the rest of our videos of how to really determine a high probability absorption play. So let's commence looking at this marker now. Now what we'll be watching is this 45 to 47 area, and you can really see in a rather anomaly area of absorption being the 46 to 45, where there's approximately 9,000 contracts that have been traded over here. And let me just bring this to your attention. So let's take a draw, and so what we're looking at is right over here, this area over here. So as you can see, there's 44, 45, 46, but namely this 45 and 46 region. So that's where we're keeping a very close eye on as we watch the absorption area. Now do remember, what's very important when you are watching an absorption area is to know the general momentum and the velocity of your market, and how fast the exchange does happen at per price, and also knowing when there's an anomaly area of exchange. And when you observe that anomaly area of exchange, it temporarily puts a break in the market. And when you see that break, well, then what type of trading strategy are you going to deploy in order to effectively execute? So now let's have a look again and see how this market trades. So we've observed now that there's potentially someone that keeps on reloading the 45s. You can see keeps on reloading here at the 45, 46, and we've just jumped up to 47s. Again, been about 9,000 contracts, and we had a false little move below the 45s just to test. We just wanted to see if the market, and you can see now the trader is putting an order right in here at 46s. Observe that once it traded through the 45s, and we put in a 530 lot there and a 600 lot, it snapped straight back above the price again. So the moment it snapped straight back above the price again, it automatically telling you that the sellers are really struggling. They really are struggling to hold the market much below, and in the beginning we're noticing a very large amount of exchange happening at fairly rapid rapid pace, and rapid pace being defined of how many lots are being traded, in this instance per second. So the play that we're looking at here is an absorption play. The pattern type is a low of day iceberger. So always know at your critical areas, either your high of day or low day, what does a high amount of volume look like, or what does a low amount of volume look like. And when you see amount being exchanged of almost 10,000 contract in this specific market, in the Bund, once it's traded from the highs to the lows of the day, and you see the market being blocked out of the 45s and 46s, well, we're looking to execute a potential trading strategy called the iceberg partner. And what you're going to be doing with the iceberg partner is you're going to be distributing your clip size. So the iceberg partner is effectively, you're going to be partnering inside with the iceberg. So you're going to be positioning yourself where you're looking at the 167.45 and 46s and potentially the 47s, and you're going to be distributing your clip in this area. Now your risk on the trade is effectively, it shouldn't go lower than the 43s, because already we had a little peak below and the market snapped straight back above. So you're watching this area here, watching this area over here. As you see the lots being accumulated, we had 4,300 lots over here, another almost 6,000 lots over here. As the market offers into this bid over here keeps on reloading. So it disappears but then reloads, disappears and reloads. So it's either called a reloader or it's called an iceberg. And so the strategy is an iceberg partner, where you distribute your clip on the 45s, 46s, and you're scalping, between 1, 2, 3 ticks, and maybe building one little core position. So you could put in 2 lot in, another 2 lots, and then you're executing out for a couple of ticks. So just remember, that's how you want to execute this trade, where you're distributing your clip, you're scalping a few as the market blips up, and potentially holding core position for the market to trade a little bit higher. And that's how you want to be executing this trade. So let's watch how this trade is being executed. We're quite fortunate to see this trade being executed in real time once the trader has observed this absorption. He's clipping away with clips of 2 lots. So now let's have a look how this really trades out. So as you can see, he's waiting to get his fill. Got his fill. Now look here, it's gone 300 lot offered. But let's watch now as the market. You can see there's the absorption between 45s. Where the reloading happens, and it failed to follow through to the downside, just what we discussed. Now let's have a look. So it's 200 lot offered at 46s, and we want to see if the iceberg still maintains itself. Now it's just gone, there we go, it's reloaded the 46s. We've gone up now a couple of ticks on side, 3-4 ticks, might start scalping, so I've just scalped out at the 46s. Now you'll see that this market actually continues a little bit higher. So in the first instance, the trader just entered the absorption, scalped it for 3 ticks. But if the market comes back here again, as you can see, it's come back here again. We've got 6,000 lots now. The trader's getting a little bit more aggressive over here at the 45s. So notice it came back down, went bid back again, has bought 2 lots, actually scalped, bought 4 lots, scalped 2 out at 45s, and now it's gone on side again. So again, already there's just a lot of absorption. Now the absorption play can shift from high velocity environment, where the offers are being hit quite aggressively into the bid, and the market holds up nicely. Now, when the market really starts moving away and really starts moving towards the upside, so as the market starts moving towards the upside, if the offer comes back down and the velocity of the sell orders going through the book start decreasing relative to what it was doing in the first instance when it first started trading between 45s and 46s. So what I'm saying is, when there were maybe 500 lots going through the market per 30 seconds, slows down to 500 lots per 1 minute, well, all of a sudden the sellers are slowly starting to lose they're slowly starting to lose their power and the ability to hit the bid, and I mean to absolutely hit the bid. So what you're doing in that instance, you're starting to say, well, all of a sudden this market is tiring on the sell side, and as it starts tiring on the sell side, your conviction levels on the buy side start actually increasing. So in the first instance, you observe that there's a potential reload on iceberg, so you're more scalping. But then once the seller starts slowing down, you start saying, well, potentially the buyer is going to win this battle. And in that instance, the market can actually start rotating a lot higher as the sellers, for at least this round, start giving up. So we're going to start watching how this really starts trading out. So let's have a look as we continue watching this area now over here. So we've been absorbed the 46. You can see the activity has started to slow down as the buyers now start really moving upwards along the price ladder, start moving up the page, and you can see, look how obvious this is. We have almost 15,000 contracts trading at 46s and 45s. So a clear iceberg, a clear potential volume slice order, not a potential time slice order, but a volume slice and an iceberg. And so the trading strategy is you join the iceberg that you observe, or if you are short, you start exiting your position. So really very key to understand where you observe an iceberg at a high or a low of a day, and it helps you manage your position a lot more effectively. So what we're going to do now, we're shifting our observation to the Euro Stocks. You can see we've just gone short here on the Euro Stocks. There's going to be another pattern that we're going to be trading, an absorption pattern at the high of day in the Euro Stocks. Now here is what we're looking at. So let's look. So in the Euro Stocks, we're looking at an absorption at the high of day. Remember, you always know what an absorption at the high of day or the low of day is when you understand your market intrinsically well. And so, in the oil market, it might be a 300 lot and a 400 lot being distributed at the high of day. In the Euro Stocks, it's between 7 to 10,000 lots. So through your observations, through your journalizing, as you watch your markets day in, day out, you start getting to understand the specific personality of your market. And once you start understanding the specific personality of your market, you know what a potential strong iceberg is. And given the speed that the market is auctioning the orders and the orders that are being traded on the book, you're able to execute a lot more confidently because you understand your market's personality. So what we're looking for here again is an iceberg partner. We're looking for an iceberg partner distribution. The market environment is high volume, moving to low auctioning activity. So what I mean by that is, firstly, there's a lot of intense volume that's going through. At that stage, you might actually wait because the VPOC has shifted, with VPOC meaning the volume point of control, where the most area of volume has been traded. So if the most area of volume been traded has moved towards the upside, and as it's moved towards the upside, if the volume velocity on the orders being traded continues in an aggressive manner, the iceberg might start giving up his position and the market could continue towards the upside. So the best way to trade this is you see the iceberg and the absorption happening, or the reloading happening on the offer side, but then all of a sudden the buy side activity starts decreasing in activity, and the auctioning starts decreasing. And the moment you notice that the auctioning speed starts decreasing, then you know that the absorber is starting to win the battle, and that's when you start actually entering your trade. So what again you want to see, first you want to observe the absorber, and once you have observed the absorber or the iceberg, you want to see the velocity exchange on the prices start decreasing, the relative rate of exchange start decreasing. And the trade, what we're looking for over here is we're looking for a scalp. Your risk management, 1, 2, 3 ticks. Your reward management is effectively looking for the low volume node here at the 82s. And as the market starts trading, you want to see how the market starts trading back towards this area over here. So let's have a look how this continues to trade. So we're looking at the 89s, and you can see, okay, we still gets re-offered at the 89s, gets re-offered, the iceberg is there, 10,000 lots being charged at the 89s, and keeps on changing. But all of a sudden what is happening, that the bids are 1 lot, 5 lot on the bid, 1 lot again. Really struggling, and the offers are a little bit stronger. There is a bit of a buy here at 88s, but once he steps out the way, and if he can't lift the 89s, well, then it's going to start to. So you can see all of a sudden the bid is still trying to maintain. There we go, 700 lots have gone through, but the offer reloads again. Reloads, and he puts a nice firm stomp on there of another 800 lots. 500 lots over here. Now the bid is still struggling to to go towards the upside, and we're just slowly observing. What we want to see is, you see this green box here and the white box. You want to see this speed start slowing down, because the moment it starts slowing down, the auction market theory suggests that as it starts slowing down, the market will want to auction towards the other side. And as we watch over here, the market, once it starts really slowing down on the velocity, as we discussed in the previous module of market velocity, we really start seeing the market potentially moving back down towards the 82. So still watching this. The trader at the moment still holding his 89s, because he's liking what he's seeing at 89s. He's liking every time the buyer steps up towards 89, he re-offers. Now all of a sudden the 88s have disappeared. So now look here, the 88s have stepped back in, but he's not taking much of 89. 89 is still standing firm. Now we've just had to go on quickly bid over. There's still some size here. The trader's still holding on to his 89s. The risk on this trade will potentially be at the 92s. 1, 2, 3 ticks. Might be able to get a short, but again the 89s holds firm. We've now had 20,000 contracts traded at 88. We've had 13,000 contracts traded at 89 and 6,000 contracts traded at 90. I mean, a significant amount of volume trading up here, and there's going to be a pinch point. It's always the ability to collect where the pinch point, where the buyers will start feeling the pain. If this market starts trading, below 87, 86, the buyers will potentially start covering back towards this low volume node. So again, 89s and 90s keep on holding, and as you see, as this video continues, you'll slowly start seeing the velocity and volume on the ladder really starting to slow down, and as that starts slowing down, it starts suggesting that the seller is starting to win at this battle. And we're still watching 89, still holding 88s, keeps on. So it's this battle between 88s and 89s, but because the velocity is slowing down, it's starting to really, for the first time now, the 88s are trying to hold the offer. You see now the 88s are coming and holding the offer. A lot more company there. 87s have been taken out now. So we've got 88s, 87s. Now, are we going to get a little bit more pain towards the downside? Are 86 going to be taken? I'm doing almost a horse commentary for you right here, but we can start seeing that the 86s have been taken out, the 85s have been taken out, and as the market slowly starts moving towards the 82s, and the trader actually exited 85s, but subsequently this market did start moving towards this low volume node. So that's really two key illustrations of absorption plays, one in the Euro Stoxx at the high of day, one in the Bund at the low of day. You can see at the Bund now has moved up towards the 52. So two really beautiful absorption plays, and how to scalp and trade around them, and how to potentially build a core position. And this is really important on how to position on potential volume slice orders or on iceberg partner plays.